Dollar is lower. Major global stock market indices are mostly higher, and U.S. equity futures are up. That's in part on the Bloomberg News report that President-elect Trump's economic team is considering a gradual ramp-up of tariffs as a way to avert inflation spikes. The story says that graduated trade tariffs of about 2 to 5% a month are under discussion. Let's bring in our featured guest to discuss this and other market-related topics. Colin Cieszynski is the chief market strategist at the SIA Wealth Management here in studio. There he is. How are you, sir?
Great. How are you today?
I'm very well, thanks.
Good.
So what do you make of that? If the Trump economic team brought in graduated tariffs, maybe 2 to 5% a month, would that make a difference?
I think that's much more encouraging than trying to hit it all at once. We've seen in the past where the market doesn't like tariffs. We've seen in the past where we've seen sell-offs in the stock market after large tariffs are brought in very quickly, because they do have an impact. And things like a 25% plus tariffs could be quite disruptive for a lot of industries and huge chunks of the economies, and really on both sides of the border. It's certainly better for us being the target of tariffs if they're brought in more slowly. But also, I mean, our economies are so integrated that it's better for them too, because they're certainly, at the end of the day, you can't do it without having some kind of blowback on both sides of the border.
Colin, overall, you think that investors are shifting their focus right now. What do you mean by that?
I mean that right after the U.S. election, we had a big 6 weeks rally. It was from the U.S. election to the Fed meeting. And everybody was, okay, well, Trump's going to get in. He's going to do all kinds of wonderful things. He's going to have his way. There'll be no opposition. And life is wonderful. Sunshine and rainbows. And then the Fed came along and said, well, the economy's doing better, and we're going to cut back the number of rate cuts. And that's important because underpinning the bull market that started at the end of 2023 was the notion that there would be aggressive rate cuts in the United States. And what's interesting is we've had aggressive rate cuts in Canada, but not as much in the U.S. They've cut about 1%. Canada's cut more like 2%. I think the market was expecting the Fed to do what the Bank of Canada did, and hasn't, and that they probably won't this year either. And because of that, we've seen Treasury yields push back up. We've seen the U.S. dollar go up, and we've seen stock markets come off.
Right. Now, in terms of inflation, we're going to get a couple of key readings this week. Today at 8:30 Eastern, I believe, wholesale prices in the U.S., PPI, expected to come in at 2.8%. And then CPI, Consumer Price Index, tomorrow, 2.9. We know that inflation, as it turns out, bottomed the CPI level and the headline level, 2.4 in September, creeping up towards 3 now. And so that goes to what you're talking about. Well, what are your expectations, and how concerning is it that inflation keeps ticking higher like this?
Well, it is a concern. I mean, from time to time, you see memes on the internet talk about trying to compare this to the 70s, the 2020s to 1970s, and the idea that you had one wave of inflation and then you had a second, even bigger wave of inflation. And so that's the lingering concern is, do we have the central banks really defeated inflation, or have they just defeated it for now and there's another wave coming? And I think that's why when we see things like talk about tariffs, because tariffs are inflationary, especially if you have a huge bump all at once. But even as you mentioned, creeping inflation, or we start seeing natural gas prices go back up the way they have in the last couple of weeks, or oil prices and things. But it just seems as though there's a lingering question out there now of, is there another wave of inflation still out there?
There's a look at natural gas, down a bit today, but it has had quite a run. Not to mention, and there's WTI, as we see there on your screen, but not to mention cocoa prices, coffee prices, that there is inflation out there, to be sure. And so the bond market is reacting. We're seeing yields go up, as you say, and bonds are falling. And what's your overall take on bonds in terms of trying to incorporate them into portfolios? Is it tricky right now? There have been a lot of false dawns. Okay, here's the bottom. Now's the time to buy, and it never really seems to be.
It has been tricky to try and include bonds in a meaningful way, because we had a major shift in the trend of interest rates a couple of years ago. We were for 40 years, we had interest rates generally trending down and bonds generally going up. And that switched about 2021, 22. And since then, we've now seen yields, interest rates starting to creep back up, and bond prices had been under pressure. And these kind of really long-term market trends, which, as we see in the bond market, can play out over decades. And now we're in this transition period of, okay, well, we've gone down. Is this just a short-term bump up of a few years, or is this a more significant and lasting change? And I don't think anybody really quite knows yet.
And just overall, Colin, before we take a break, does the uncertainty about Trump and his policies and tariffs and so on, does it make it more difficult to assess what sectors and stocks to be in and just to manage money in general?
It does. It's a little bit tricky right now, and that's why it's important to, what we do at SIA is we look at capital flows and we look at where is the money flowing between sectors, between asset classes. And that helps to give an idea, because the larger money tends to have a pretty good idea of where things might be heading. And so over time, we can track these kind of flows to get an idea of what people are thinking.